Welcome to the Deep Dive. We're the show that takes your source material, digs deep, and pulls out what you really need to know.
We cut through that noise.
Exactly. And today, we've got a really interesting one. A paradox, you could say.
Mm-hmm.
We're looking at a company, Cognition Therapeutics, with this innovative Alzheimer's drug. It shows, real scientific promise. It's even got big federal grants backing it up.
Right. Substantial grants.
But here's the twist. The stock is trading for less than $1. Pennies, really.
Yeah.
So the question is the market just completely missing something huge here? A potential game changer for Alzheimer's? Or is this company basically on borrowed time, financially speaking?
That's the core tension. And by the end of this deep dive, you, the listener, should have a much clearer picture of what's actually going on, why it's such a binary bet, high risk, high reward.
Absolutely. So let's get into it. The company is Cognition Therapeutics, Inc., ticker symbol CGTX on the NASDAQ.
That's right. And all our analysis is current as of yesterday, July 8th, 2025. CGTX closed at 0.3245 cents per share. Tiny. Our mission today, to really dissect this thing, the science, the management, the money, the market feeling, and figure out if there's real fundamental value here for an investor, or if it's just too speculative.
Okay, great setup. So let's start with the basics. Lay the foundation for us. What exactly is Cognition Therapeutics' business?
Chapter 1, Business Analysis.
All right.
Well, fundamentally, Cognition Therapeutics is a clinical stage biopharmaceutical company. And what that means, really, is they're all about research and development, R&D.
Okay. No products on the shelves yet.
No, none. Their entire focus, their whole reason for being right now is developing drugs and trying to get them through clinical trials and approved by regulators like the FDA.
So it's that classic biotech model, high risk, potentially massive reward down the line.
Exactly. It's pretty much an all-or-nothing situation until they, hopefully get a drug approved and start selling it.
And that focus on R&D, that must shape where their money comes from right now.
Absolutely. Since they aren't selling anything, their income, it comes almost entirely from external research grants.
Okay.
And the really big one, the one that gets a lot of attention, is an $81 million grant from the National Institute on Aging, the NIA.
$81 million, that's significant.
It's huge. And critically, it's for their START study, which we'll talk about. But what's really compelling, beyond the dollar amount, is that it's non-dilutive capital.
Meaning they didn't have to sell more stock, watering down existing shareholders to get that cash.
Precisely. That's a big plus. And it's also, a powerful endorsement. Getting that kind of grant involves rigorous peer review. It's like a stamp of approval on their scientific approach.
But it's not ongoing revenue, right? It's tied to that specific project.
Exactly. It's finite, project specific. It highlights how dependent they are on trial success to keep attracting more funding, whether it's grants or investment.
Okay. And that funding, it's all going into their drug pipeline. Let's talk about the main event. Zervimesine, or CT-8012. What makes this drug special? Because the science sounds quite different.
It really is. Zervimesine is their lead candidate. It's a small molecule drug, which means it can be taken as a pill, orally delivered, once a day. That's a big deal in itself for patient convenience.
Much easier than infusions, yeah.
Way easier. And it's being developed for neurodegenerative disorders, primarily Alzheimer's right now. But the really interesting part, as you said, is its unique mechanism. It targets something called the sigma-2 receptor.
Sigma-2. Okay, what does that do?
Think of it like a cellular housekeeper inside brain cells. Its job is to help clear out the toxic proteins like amyloid and tau that build up in diseases like Alzheimer's and dementia with Lewy bodies.
So it's not directly attacking the amyloid plaques like some other big drugs we hear about.
Exactly. It's functionally distinct from those anti-amyloid monoclonal antibodies, which are large molecules given by infusion.
Huh?
Zervimesine works inside the cell to help it clean itself up. And again, that oral once-a-day potential is a massive market advantage if it works.
Okay, very interesting approach. So how far along is Zervimesine? What does the clinical pipeline look like?
All right, so the pipeline is really centered on this drug. First, there's the START trial. That's for early Alzheimer's disease. It's in phase 2, and it's ongoing right now.
The one funded by the NIA grant.
That's the one. Funded by that $81 million grant. And importantly, they've already enrolled over half of their target. They're aiming for 540 people. So, making progress there.
Good. What else?
Then there's the SHINE trial. This was also phase 2, but for mild to moderate Alzheimer's. This one's completed.
And the results?
They showed something pretty remarkable. A 95% slowing of cognitive decline. But, and this is key, it was in a specific subgroup of patients.
Okay, which subgroup?
patients who had lower levels of a specific biomarker in their blood, called plasma p-tau217. That biomarker is linked to tau tangles in the brain. So it suggests the drug might work particularly well in patients with that specific profile.
Interesting. Biomarker-driven results. That fits with market trends.
It does. Then there's the Shimmer trial. This one was for dementia with Lewy bodies, or DLB. Also phase 2, also completed.
How did that go?
It met its main goal, which was showing the drug was safe and well tolerated. And, encouragingly, it also showed positive signals, therapeutic responses across behavior, cognition, and movement symptoms in those DLB patients.
Okay, so promising signals across multiple conditions. Any others?
Well, there was the Magnify-Y trial for geographic atrophy in eye disease. That was phase 2 as well. Yeah, they strategically discontinued it earlier this year. Now, it's really important to stress this wasn't because of safety issues or bad data.
Ah, a strategic move then.
Exactly. It was a calculated decision to conserve cash and focus all their resources on the Alzheimer's and DLB programs, which they see as having the highest potential. A tough choice, but probably necessary given their finances.
Makes sense. So, okay, we have this promising drug, these trials. Where does Cognition Therapeutics actually sit in the market? You mentioned they're tiny.
Yeah, really tiny. It's a microcap company. Its market cap, the total value of its stock bounces around a lot, but it's been roughly between, say, $18 million and $36 million recently.
Just to put that in perspective.
Right, compare that to the giants. AstraZeneca's over $200 billion. Even a company like Biogen, focused on neurology, is over $17 billion.
So CGTX is just a speck in comparison.
The tiny speck. It really puts them in the category of a niche player. They are betting the entire farm, basically, on this one core technology, this Sigma-2 approach with zervimesine.
So their whole value proposition hinges on that.
Pretty much. It's the potential to be a first-in-class, orally administered small molecule drug for these huge neurodegenerative diseases using a novel mechanism. That's the pitch. That's the potential payoff.
And the market they're aiming for, Alzheimer's, is just enormous.
Absolutely immense. And growing fast. We're talking a market potentially worth, what, $4 to $5.6 billion this year, 2025?
Yeah.
And projections show it climbing to over $11 billion by 2032. That's a compound annual growth rate of somewhere between 6% and maybe over 10%.
Driven by aging populations worldwide.
Exactly. It's a massive, growing, unmet need.
And within that market, are there specific trends that CGTX is tapping into?
Yes, two really key ones. First, there's a big shift towards trying to treat Alzheimer's much earlier, in the very early stages, even before major symptoms appear.
Intervening sooner.
Right. And second, there's the increasing use of biomarkers like that p-tau217 we mentioned for diagnosis, and crucially, for selecting the right patients for the right trials or treatments.
And CGTX aligns with these?
Very strongly. Their START trial targets early AD, and the SHINE trial results specifically highlighted that biomarker subgroup. So they seem well-positioned to ride these waves.
Okay, but alignment doesn't mean lack of competition. This field is brutal.
Fiercely competitive.
Right.
You've got the established giants, Eli Lilly, Biogen, Roche, pouring billions into Alzheimer's research.
Right.
And then you have other biotechs. If you compare CGTX, we're around a $28 million market cap currently, to some peers, like Acumen Pharmaceuticals is maybe $68 million, Alpha Cognition is closer to $170 million, and they've actually submitted a drug for approval.
So CGTX is trading way below those peers, significantly below. And the market seems to be saying that discount is because of the financial overhang, the cash crunch risk, more than a lack of scientific potential, perhaps.
Now, what about the regulators, the FDA? Is the environment helpful or a hindrance?
Actually, it's potentially quite helpful right now. The FDA has pathways like the Accelerated Approval Program.
Right, that lets drugs get approved faster based on surrogate endpoints.
Exactly, things like biomarker changes, rather than waiting years for definitive proof of slowing cognitive decline, which takes huge, long trials. And the FDA even issued guidance in March 2024 specifically for early-stage Alzheimer's drugs, encouraging biomarker use.
So that plays right into CGTX's hands, especially with their biomarker data.
It does, and it makes their upcoming end-of-phase 2 meeting with the FDA, scheduled for tomorrow, July 9th, incredibly important. That meeting could clarify the path forward, potentially even towards accelerated approval if the data holds up.
But even with regulatory help, getting a drug, especially an Alzheimer's drug, to market is incredibly hard. The barriers must be huge. Exceptionally high barriers. You need massive amounts of capital. Development timelines stretch over a decade, easily. The failure rate is notoriously high. Alzheimer's is often called a graveyard for drugs for a reason.
Yeah.
Plus, you have complex intellectual property issues, and navigating the stringent regulatory hurdles themselves is a huge challenge. It's tough for anyone, let alone a tiny microcap.
So does CGTX have any kind of competitive advantage, any moat to protect itself?
They have a few potential advantages. First is their intellectual property. They have patents protecting their sigma-2 receptor modulators. That's key.
Okay.
Second is that unique scientific approach. By targeting sigma-2, they're differentiating themselves from the very crowded amyloid beta field where many others are focused.
A different angle.
Right. And third, and this shouldn't be underestimated, is the external validation via grant funding. That $81 million NIA grant provides significant scientific credibility. It's a stamp of approval from experts that's hard for competitors to just buy.
Okay, let's pause there for a sec. It's interesting. The source notes we reviewed for this deep dive actually included a message from the original researchers. They wanted us to pass this along. Like and subscribe to Stock Analytics AI YouTube channel. Remember, members can add stock suggestions for future videos in the comments, and we will pick them up.
Ah, right. A plug from the source material itself.
Yeah.
Got it.
So, okay, we've got the business, the science, the market. Who's actually leading this company? Who's making the decisions?
Chapter 2, Management Evaluation.
Let's hear it.
The CEO is Lisa Ricciardi. She came on board in March 2020. And what's really striking about her background is her track record. She's known as a deal maker.
Oh, like what kind of deals?
Big ones. For instance, she was involved in the $1 billion sale of Foundation Medicine to Roche, and she played a key role in Medco's massive $29 billion sale to Express Scripts.
Wow, okay. That's not building a company from scratch, that's positioning for an exit.
Precisely. Her background strongly suggests the strategy here isn't necessarily to build Cognition Therapeutics into a fully integrated commercial pharma company themselves.
Right.
It's more likely about getting zervimesine to a key value point, maybe strong end-of-phase 2 data, a clear path laid out for phase 3, and then seeking a strategic exit.
Like a partnership or selling the company outright to a bigger player.
Exactly. A partnership where a big pharma company takes over late-stage development and commercialization, or a full acquisition, that plays to her strengths.
And we saw a glimpse of that strategic thinking with the Magnify White trial decision, right? Halting it to save cash.
That's a perfect example. That decision, made early this year, showed they're willing to make tough calls on capital allocation to protect their core assets, the Alzheimer's and DLB programs. It demonstrates disciplined leadership, especially when cash is tight.
How are they on communication? Are they transparent with investors?
From what we can see, they follow standard practices for a public company. Regular press releases on clinical updates, financial results, SEC filings, investor calls. We didn't find any red flags like ethical scandals or signs they're hiding bad news. Seems pretty standard.
And capital allocation, you mentioned the Magnify White decision. Where does the rest of the money go?
Pretty simple. Almost every dollar goes into R&D. Clinical trials, basically.
That makes sense.
And in Q1 2025, R&D spend was $10.8 million. For the full year 2024, it was $41.7 million. They are burning cash to push those trials forward. This clearly positions them as a potential target for acquisition, not a company looking to buy others.
And things like dividends or buybacks?
Absolutely not. They've never paid a dividend, no share buyback program, which is totally appropriate for a company in their stage. They need every penny for research.
But they are issuing shares.
Oh, yes. That's the flip side. Shares outstanding increased by a massive, almost 50%, 49.90% year over year.
Ouch. That's significant dilution.
Huge dilution. And that's a core part of the bear case. Each existing share gets diluted, representing a smaller piece of the potential future pie. It's a constant headwind for the stock price.
Okay, last management point. Return on invested capital, ROIC, it's deeply negative, like negative 156%. What does that tell us?
In this context, for a pre-revenue biotech, it's kind of expected. It simply reflects those huge upfront R&D investments that haven't generated any return yet.
So it's not necessarily bad management, just the stage they're in.
Exactly. The whole investment thesis is a bet that future profits will eventually generate a positive return on all this invested capital. That negative number just shows where they are on that journey.
All right, let's dive deeper into those financials then. The numbers tell a critical story here.
Chapter 3, Financial Analysis.
Laid it on us.
Okay, first that market cap we talked about. Around $25 million as of yesterday, but super volatile. Recently bouncing between roughly $16 million and $36 million. Definitely microcap territory, high risk baked in.
And revenue growth.
Not really applicable. No product sales. Income is just that lumpy grant funding we discussed, not a reliable growth metric.
So profits.
None. Margins are deeply negative. They lost $34 million in fiscal year 2024 and another $8.5 million just in the first quarter of 2025. Standard cash burn for R&D stage.
Which brings us to the absolute key metric here. Cash burn or negative free cash flow.
This is the crux of it. For the last 12 months, their cash burn was around negative $31 million.
31 million out the door.
Yes, and that's the ticking clock.
Because they don't have unlimited cash.
Far from it. As of the end of March 2025, they had $16.4 million in cash left.
16.4 million.
Yeah.
And burning 31 million a year.
You see the problem. The company itself stated in their filings that this cash is only expected to last into the fourth quarter of 2025.
So they could run out of money before the end of this year.
That's the urgent reality. It creates this immense pressure for a major positive event very soon, like really good news from that FDA meeting tomorrow, or landing a big partnership deal, or finding new financing fast. The runway is incredibly short.
Wow. Okay, so earnings consistency is consistently negative.
Consistently negative, yes. Losses have actually been growing as they ramp up trial activity. Profitability, if it ever comes, is likely years away, probably into the early 2030s if everything goes perfectly.
What about their balance sheet? Debt?
Very little debt, which is good. Debt-to-equity ratio is super low, 0.05. They're financed almost entirely by equity selling stock and those grants.
Okay, and the current ratio? Assets versus liabilities.
On paper, it looks okay, around 2.09. That usually suggests they can cover near-term bills.
But the cash is disappearing fast.
Exactly. That ratio is misleading because the A in assets, the cash part, is shrinking rapidly. So that apparent stability is temporary unless new cash comes in.
And valuation metrics like PE.
Price to earnings is negative, negative 0.61, so completely useless here. You can't value them based on current earnings because there aren't any.
So how do you even attempt to value a company like this?
Well, you can use something like a risk-adjusted discounted cash flow model, or DCF, and this is but it's purely an educational tool here, highly speculative.
Okay, how does that work?
You have to forecast potential future profits way out into the future, assuming the drug gets approved, captures a certain market share, etc. Then you heavily discount those uncertain future profits back to what they're worth today.
And the key inputs must be super uncertain.
Critically uncertain. You need to estimate the probability of success at each clinical stage, which is low for Alzheimer's drugs. And you need to use a very high discount rate, maybe 25% or even higher, to reflect the extreme risk involved.
So running those kinds of numbers, what sort of speculative value range might you get, just as an illustration?
As an illustration only, you might land somewhere in the range of, say, $1.50 to $3.50 per share.
Okay, $1.50 to $3.50 compared to the current price around 32 cents.
Right, a huge gap. But again, that range is built on very shaky assumptions.
What are those key assumptions?
You're assuming maybe a 15–20% chance of success for a phase 2 AD drug, perhaps slightly higher here because of the biomarker data, but still low overall. You're assuming potential peak sales, if approved, maybe around $2 billion annually. You're using that very high 25% discount rate. And crucially, you're baking in significant future shareholder dilution because you know they'll need to sell a lot more stock to get there.
Got it. Highly speculative, but shows the potential disconnect if the science pans out.
Okay, let's shift gears now and look at how the actual market feels about CGTX.
Chapter 4. Market sentiment.
What's the vibe out there?
It's fascinatingly disconnected. On one hand, you have Wall Street analysts. They have a strong buy consensus rating on the stock.
Strong buy, really?
Yep, and their price targets are way up there, ranging from about $2 up to over $7, with an average around $4 or $8.
$4 average target versus a 32-cent stock price. That's not just a disconnect, that's a chasm. It's a massive chasm, and it really tells the story. The analysts seem to be valuing the asset, the potential of zervimesine, the science, the future market. Their models are looking way ahead.
Okay.
But the market, the actual stock price, seems to be valuing the company as it exists today, a vehicle that's about to run out of gas. It's pricing in a high probability of a financial crisis, a going concern issue, or just brutal value-destroying dilution.
So the market is focused on the immediate financial danger, while analysts are focused on the long-term scientific potential.
That seems to be the core conflict. And it forces you, the investor, to ask who's right, or what timeline are you investing for?
What's also weird is how the stock reacts or doesn't react to news. Company press releases have sounded pretty good lately, right?
Overwhelmingly positive, actually. Good enrollment news for the START trial, positive data readouts from Shimmer, Media headlines picked up on that
Of
optimism.
the stock price.
Collapse, down over 80% in the past year, despite that positive news flow. It powerfully shows that right now, the market is almost entirely fixated on that financial risk. The positive clinical news isn't enough to overcome the fear of running out of money.
What about other market indicators? Short interest, people betting against the stock.
It's elevated. Somewhere between 2.77% and 3.06% of the available shares are sold short. Not extremely high, but significant for a microcap.
And is it increasing?
Dramatically. The number of shares shorted jumped over 103% from the previous reporting period. That suggests bears are piling in, likely anticipating dilution or some kind of financing event that pushes the price down further.
And technically, the stock chart.
Well, price is hovering right around its 50-day moving average, about 33 cents. So no real short-term momentum either way. But it's way below its 200-day moving average, which is up at 47 cents.
Confirming the longer-term downtrend.
Exactly. Strong, long-term bearish trend is clear from the chart, reflecting that market focus on the financials.
Okay, so if the market's so negative, who actually owns this stock? Is anyone sticking with it?
Chapter 5. Ownership structure.
Who's holding the bag or the potential lottery ticket?
Well, overall institutional ownership is pretty low, somewhere between 18% and 27%. Not surprising for a risky microcap.
But is there anyone significant in that group?
Yes, and this is really important. The largest institutional holder by far is Bios Capital Management. They're a venture capital firm that specializes specifically in life sciences. They hold 6 million shares.
A specialist VC firm. That sounds like smart money.
That's exactly the implication. Their large, concentrated position, they own a significant chunk of the company, suggests they've done very deep due diligence.
And they're active too.
Yes, they have board representation. Aaron Fletcher and Leslie Kreis from Bios Capital are on Cognition's board. This signals real conviction. They seem to believe the potential of zervimesine outweighs the very obvious risks. It's a strong counter-signal to the market's pessimism.
What about insiders? Management, board members?
Insider holdings are relatively small, around 3.34%. We see the usual stuff, grants of restricted stock units, RSUs, as part of compensation. And you see some sell-to-cover transactions where they sell just enough stock to cover the taxes owed on those RSU grants. That's normal.
But no big discretionary selling, like the CEO dumping shares.
Critically, no. We haven't seen significant open market sales by key insiders, which would be a major red flag if they were quietly hitting for the exits.
So ownership is pretty concentrated then, with Bios Capital being the dominant player.
Highly concentrated, which, as we discussed, is a double-edged sword.
Right. Good to have a strong advocate, but risky if they ever decide to sell.
Exactly. Their decision could massively swing the stock price, given how few shares are actively traded.
Okay, let's try to pull all these threads together now with a risk assessment, maybe a SWOT analysis. Strengths, weaknesses, opportunities, threats.
Chapter 6, Risk Assessment. Sounds good. Let's start with strengths.
Go for it.
First, clearly the novel science, that differentiated sigma-2 mechanism. Second, the promising clinical data we've seen, especially the SHINE biomarker subgroup and the SHIMMER DLB results. Third, that external scientific validation from the $81 million NIA grant. That's a big credibility booster. And fourth, the experienced transaction-focused leadership in CEO Lisa Ricciardi, who seems geared towards a strategic exit.
All right, solid strengths. Now, the weaknesses. These seem pretty stark.
They are. Top of the list. The existential cash burn and the very short cash runway, only lasting into Q4 2025.
The ticking clock.
Ticking clock. Tied to that is the complete lack of revenue, making them totally dependent on outside capital, which leads directly to the third weakness. Inevitable shareholder dilution is coming if they survive.
Right.
And finally, just their small size and scale. They lack the resources of the giants they're competing against.
Okay, weaknesses noted. What about opportunities? What could go right?
Well, the biggest opportunity is the massive unmet medical need in Alzheimer's. If they succeed, the potential market is enormous true blockbuster potential.
Trillions of dollars eventually.
Potentially. Second, the favorable regulatory environment with the FDA's focus on accelerated approval and biomarkers. Third, they're a prime acquisition target, especially if they get positive end-of-phase 2 data and a clear path forward.
Makes sense for Ricciardi's background.
Exactly. And fourth, don't forget the oral administration advantage of zervimesine. Huge plus for patients and doctors compared to infusions.
Okay. Strengths, weaknesses, opportunities. Now, the threats. What could derail this?
The single biggest threat, bar none, is clinical trial failure. Alzheimer's drug development has an incredibly high failure rate. One bad trial readout could be fatal for the company.
The graveyard looms.
It does. Second is just the intense competition from much larger, better-funded players. Third is financing risk, the threat they simply can't raise enough money on acceptable terms before the cash runs out.
Especially in the current environment.
Right. Which leads to the fourth threat. Macroeconomic factors. High interest rates make raising capital harder and more expensive, and they also increase the discount rate used in valuations, hurting the perceived value.
Any geopolitical risks?
Unlikely to be a major factor at this stage. They're focused on clinical trials, mostly in developed countries, maybe supply chain issues down the line, but not the primary threat now.
Okay, that gives us a really clear picture of the landscape. Let's try to wrap this all up.
Chapter 7. Conclusion.
So, synthesizing everything, what's the bottom line here? Let's start with the bull case. Why might someone invest in CGTX?
The bull case rests on that novel oral drug, zervimesine, with its differentiated mechanism. You've got compelling, albeit early, phase 2 data, especially in that biomarker subgroup. You have strong validation from the NIA grant.
Right.
Their strategy aligns well with where the FDA and the whole industry are heading early, treatment, biomarker focus. And despite all that, the stock is trading at a massive discount to what analysts think it's worth, and you have specialist smart money, like Bio's Capital, invested heavily. It looks potentially deeply undervalued if the science works out.
Okay, that's the optimistic view. Now the bear case. Why would someone run screaming from this stock?
The bear case is equally powerful, maybe more immediate. It starts and ends with a dire financial situation. The cash burn is unsustainable. They're set to run out of money by year end.
Imminent danger.
Absolutely. Which means massive, painful dilution for current shareholders is almost guaranteed, even in a good scenario. You're betting against incredibly long odds given the history of Alzheimer's drug failures. And they're a tiny company fighting giants. The market price today clearly reflects this financial distress and high probability of failure or dilution.
So it really boils down to that conflict, financial reality versus scientific hope.
Precisely. And remember that speculative educational DCF model we talked about? It suggested a theoretical value range of maybe $1.50 to $3.50.
Right, based on a lot of ifs.
Exactly. Highly dependent on assumptions.
But the current share price, around 32 cents, is way, way below even that speculative range.
And that huge gap really highlights the core dilemma for an investor. You have extreme market pessimism, driven by the very real financial crunch and historical failure rates, clashing directly with the potentially compelling scientific story and market opportunity.
So the question for you, the listener, is how do you weigh that? Immediate financial danger versus potential long-term breakthrough.
That's the bet. Ultimately, an investment in CGTX today is a very high-risk, potentially high-reward binary proposition. It's likely going to swing dramatically based on near-term events.
Like that FDA meeting tomorrow.
Exactly. News from the FDA meeting, and critically, their ability to secure a partnership or new financing before that cash clock runs out. Those are the catalysts that will likely determine the immediate future here.
A real cliffhanger. Well, if you found this deep dive into Cognition Therapeutics valuable and want more insights like this that cut through the market noise, be sure to subscribe to the deep dive.
And just the standard but important disclaimer. This analysis was generated by an AI system for educational purposes only. It should absolutely not be considered financial advice. Please, always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.
So the final thought to leave you with: could this tiny cash-strapped company actually be on the verge of cracking one of the biggest medical challenges of our time, changing millions of lives? Or is it destined to become just another footnote, another casualty on that long, hard road of drug development? That's the multi-million, maybe multi-billion-dollar question for you to ponder.